Now, NVIDIA was lower early this morning on the open. Now it's moved higher on the day on the news that NVIDIA will allow customers to use rival chips in the NVIDIA process. It opens up the AI ecosystem to rivals, and that is very similar to what Microsoft did with Azure, like that, opening it up to people. So NVIDIA traded as low as 132.39 this morning, now up on the day trading over 135.60. So what we did there, remember, they have earnings coming up May 28th, which is not this week, but it's next week. So the same idea with a call calendar targeting the 140 strike in NVIDIA, but we stayed away from that earnings event. We bought the June 6th 140 call and then sold this week's May 23rd 140 call. The debit there about $3.70. It's also higher, trading about $3.95 now. So now that seems like an expensive price for a 2-week call calendar. But remember, if you extend duration into the event week, that's when the big credit will take place and you'll lower that net debit on that trade. Now, in between then, this is a bullish play. The expected move for this weekend in home video is about $6 up or down. Remember that. Whenever you look at an expected move, it's in either direction. So this one is targeting the 140 strike just inside that expected move for this week. If you were to extend duration into next week, that move is double what it is this week. So it's a hold. You have to remeasure every time you do it. So
NVIDIA is one of the most well-known companies riding the wave of the hardware supplier race sparked by the artificial intelligence AI revolution. With its chip-optimized servers for hyperscalers and organizations, NVIDIA leads the market for AI graphics processing units, GPUs. To determine which is a superior investment option right now, let's examine the fundamentals, pricing, growth forecast, and impending hazards. NVIDIA produced outstanding profits. In the fields of AI processors, data centers, gaming, and driverless cars, NVIDIA is without a doubt the industry leader. The ongoing AI revolution revolves around its products, which are in high demand from cutting-edge startups, corporations, and hyperscalers alike. For NVIDIA, the data center end market remains a dominant force. In the fourth quarter of fiscal 2025, revenues from this end market jumped 93% year-over-year to $35.58 billion. The company's ongoing superiority in AI was highlighted in NVIDIA's most recent earnings call. The growing need for next-generation AI models, which demand previously unheard-of computational capacity, was emphasized by CEO Jensen Huang. The next wave of AI adoption is anticipated to be driven by the company's Blackwell architecture, which can deliver up to 25 times the token throughput of its predecessor. With the upcoming releases of its Vera Rubin and Blackwell Ultra platforms, NVIDIA is poised to further strengthen its position as the industry leader in AI infrastructure. NVIDIA continues to be the main gainer from this revolutionary change in computing as governments, businesses, and cloud providers increase their spending in AI. However, NVIDIA's total financial development is probably going to suffer in the near future due to the recent limits put in place by the Trump administration on shipping H20 chips to China. According to Jensen Huang, the CEO of the firm, export limitations on H20 chips have cost the company $15 billion in sales, and in the first quarter of fiscal 2026, the company anticipates costs of about $5.5 billion. NVIDIA is expected to continue its high-growth trajectory in spite of the obstacles. In the first quarter of fiscal 2026, the business anticipates revenues of $43 billion, plus 2%, which represents an increase of more than 65% year-over-year. So what implications does this have for NVIDIA's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on NVIDIA stock in the comments. Your support truly helps us grow. Now, let's get back to the video.
What we're talking about is NVLink Fusion. You and I have sat through many briefings about NVLink Fusion and read and written about a lot, but it's a high-speed interconnect. You can connect lots of GPUs, and in this case, also CPUs. The main point here is NVIDIA is saying, if you are a hyperscaler, perhaps with custom silicon, then we can allow you into data centers where we dominate. And it kind of opens up this place where everyone is not only and solely reliant on one single name, which is NVIDIA.
I think the other way to look at this would be it's a business decision, right? If you have your biggest customers who are essentially creating rival efforts that may one day mean that they need less of you, why not make it easier to actually work with you? Say, hey, great, yeah, you've got a great CPU, come work with us. Hey, you've got a great GPU, come work with us. This is a way to keep people in NVIDIA's ecosystem and to stop them going elsewhere. That's the pitch.
Computex is a really big deal, and NVIDIA seems to have dominated it in more recent years. What else did we learn about things of substance that they're actually doing, if at all, anything of substance?
Well, Computex wasn't a big deal up until NVIDIA basically made it a big deal again when they started using it on this worldwide trip that they do to keep the AI momentum going. As a show, it was definitely fading away. So they put a lot of updates of things out there, robotics, new servers, new designs for data centers, are basically just trying to keep the momentum of this massive AI infrastructure build-out going.
Is there anything else happening at Computex that is not NVIDIA related?
Well, our old friend Cristiano Amon actually appeared on stage with
Qualcomm,
right? The Qualcomm CEO. As we reported a long time ago, they want to get into the data center with their technology. This is part of his diversification, and if you can't beat them, join them. So he's there saying we'll work with NVIDIA as a step towards a data center strategy, and that is very pragmatic, and we'll see how it works out.
Tariffs may be imposed on components entering the United States, which has an impact on investments in artificial intelligence, AI. Furthermore, some of the capital flows being invested in AI may be harmed by broader consumer demand. No matter what happens with tariffs, my stock will be profitable in the long run. These stocks are great to buy today, and you should buy them with the intention of holding them for 3 to 5 years. Given that it sources a large portion of its chips from outside the nation, NVIDIA would be a surprising entry to this list. Nonetheless, NVIDIA declared that by 2026, all of its next-generation Blackwell GPUs will be made in the United States. These GPUs will not be subject to tariffs because they are domestically made, with chips coming from Taiwan's Semiconductor Manufacturing's Arizona factory and then built in Foxconn and Wistron plants in Texas. Since the AI hyperscalers are still expanding their data center capacity, NVIDIA's GPUs will continue to be in high demand over the coming years. Additionally, a lot of GPUs that were first bought to train AI models will eventually wear out and need to be replaced by NVIDIA's customers. Data center capital expenditures are predicted to increase to $1 trillion by 2028 from $400 billion in 2024, according to third-party estimates. NVIDIA's growth will be further supported by this expansion, making it a solid stock to purchase or at the very least stick onto. As demonstrated sequentially over the last 6 quarters, the company will be able to sustain its trend of revenue growth of $4 to $5 billion per quarter thanks to strong Blackwell product ramps. However, an estimated $4 billion headwind is anticipated from the impending H20 export ban, which might limit sequential growth in the second quarter. Despite the company's recent gains, analyst Srini Pajuri of Raymond James reaffirmed a strong buy recommendation on the stock on May 19th, setting a price objective of $150. In order to give NVIDIA's management hope for the second half of the year, analysts continue to anticipate strong hyperscale capital expenditure patterns and recent modifications to the AI dissemination regulations. To stay informed about the latest developments from NVIDIA and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on NVIDIA stock, so please share your opinions in the comments below. Now let's dive into today's video.
Christina, what's the latest?
Well, the latest is not signing women's shirts, but he's definitely signing some hats. But NVIDIA is changing its data center approach by opening its platform to chip rivals. That was the biggest NVIDIA announcement at Computex. It's called NVLink Fusion, allowing customers to integrate their own CPUs or AI chips into NVIDIA's ecosystem for the first time. Marvell, MediaTek, Qualcomm were some of the partners listed. Competitor Broadcom, notably missing. Tech giants, though, can pair their custom silicon with NVIDIA's technology, potentially unlocking significant revenue growth as more data centers would adopt NVIDIA's server platform. So it's really about owning the entire stack. But Wedbush analyst Matt Bryson wonders if it's really going to grow market share because of limited demand for these third-party CPUs from Qualcomm, for example, and that hyperscalers would just prefer to use their internal networking products. But It's also why Qualcomm CEO told CNBC London this morning that the company will soon launch a new data center CPU specifically designed to connect with NVIDIA's GPUs and software, though the exact timeline remains unchanged. So big news coming from Qualcomm. Going back to NVIDIA, though, they also unveiled plans to partner with Foxconn on a massive AI factory supercomputer in Taiwan, powered by 10,000 Blackwell GPUs, with TSMC leveraging the system for research and development, as well as creating a second headquarter in Taiwan to provide proximity to key partners as well as employee talent. But NVIDIA shares were up, 16% last week, and Jordan Klein at Mizuho says a lot of momentum chasers came in pretty hard for Jensen last week, and many were also expecting a new NVIDIA AI PC chip as well, so could be why you saw shares open negative this morning and really just trending flat right now, David.
Yeah, Christina, although to your point, they are now flat, so they are up on the session, at least less than an hour in. Christina, thank you.
With CEO Jensen Huang announcing that the business will no longer alter the architecture to conform to U.S. export regulations, NVIDIA is discontinuing its Hopper AI chip series in China. In an effort to maintain its position in a crucial growth industry, NVIDIA is developing a new reduced processor. In the fiscal year that ended on January 26, 2025, NVIDIA's revenue from China came to $17 billion, or 13% of its overall sales. The only Hopper series device that was still legally allowed to be sent to China under U.S. regulations was the H20 chip. According to Taiwan's Formosa TV, Huang stated in a live stream that there will be no more Hopper upgrades, saying, "It's not Hopper because it's not possible to modify Hopper anymore." According to previous Reuters sources, the company is anticipated to deliver a downgraded H20 chip within 2 months in an effort to reclaim market share that it has lost to rivals like Huawei. Huang has questioned the new export limits established by the Biden administration's Framework for Artificial Intelligence Diffusion, which was released in January 2025. He maintained that rather than limiting exports, the United States should concentrate on expanding the use of its technologies throughout the world. President Donald Trump has promised to repeal those regulations, claiming they are detrimental to American interests in leading the world in technology. Huang's visit to China soon after the H20 limits went into force demonstrated NVIDIA's continued dedication to the area, in spite of the stricter regulations. Jensen Huang, CEO of NVIDIA, revealed a major change in the company's data center strategy at the 2025 Computex Technology Exhibition on Monday. There was a lot of excitement in Taiwan about Huang's visit, which is sometimes referred to as Jensanity. Despite Huang's announcements, Bernstein analyst Stacy Rasgon remained optimistic and reiterated his buy rating and $185 price target for NVIDIA stock. A detailed view of a vibrant, top-tier graphics card being connected to a gaming PC. Particularly helpful, according to Stacy Rasgon, was the company's announcement of NVLink Fusion. But the fact that big players like AMD, Broadcom, and Intel aren't present indicates that NVIDIA may be trying to outperform second-tier ASIC companies. Rasgon added that even though NVIDIA is allowing third parties to utilize its technology, this could be an attempt to take some market share away from hyperscalers who would still create their own ASICs. He emphasized that NVIDIA might win from helping its original partners, such as Marvell and MediaTek, who are second-tier companies looking to increase their market share. The analyst also discussed the elimination of diffusion rules and saw it as a short-term benefit because it removes a potential obstacle for NVIDIA's May 28th earnings announcement. The immediate removal allays worries about restrictions on NVIDIA's sales to the majority of the world, even though there is talk about replacing these regulations with bilateral agreements that are individually negotiated, especially in light of announcements made in the Middle East last week. With reference to the DGX SparkWorks stat, Rasgon also expects to continue innovating and growing into new areas outside of its core offerings, such as networking and possibly PCs. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
Weakness when you're looking at market breadth. We're only around 26% of the S&P 500 stocks in the green right now, and we're still seeing some of this defensive posturing in the market. You have healthcare, consumer staples, and utilities kind of leading the way. Consumer discretionary also pushing higher, but that's as Elon Musk is kind of talking and Tesla's pushing to the upside with some of that commentary here. But we are seeing maybe a little bit of a lack of breadth in the marketplace, a little bit more defensive positioning here. But when you're looking at the flows and when you're looking at levels for today, really kind of focus focusing on that 6,000 level to the upside here. That's been a very key area that we've been focusing on here. A lot of calls at that level. And it's going to be not only a focus for the open interest side, those contracts that expire up to 2 years, 3 years from now, but also from the volume side as well. So we've been in this uptrend. The uptrend has been good for the most part. Any pullbacks have been really bought up here. And if we see any breakdown to 5790-ish, 5800, I would expect maybe some buyers to really try to step in here, really try to hold this line and defend that 200-day moving average. But on an intraday basis, we're about 7 points away from a key area that you'd like to see some buyers stepping in, around that 5940-ish level here. If we have any type of breakdown coming back and trying to defend that 5900 level, we defended it yesterday, we defended it on Friday, as well as on Thursday. So there's been a lot of buyers at 5900. You do not want to see that level really kind of break to the downside here. Then once again, to the upside, 6,000. And 6,000 would be kind of a milestone for this recovery from the lows that we've seen just 4 weeks, 5 weeks ago here. So overall, buyers still remain, bullish in this market. Dips have been bought. Maybe we're a little bit overextended. Maybe we want to see a little bit of consolidation or come back and retest here. But the defensive positioning is something that I'm keeping my eye on here because it's actually lasted for the last couple of trading sessions. We'll talk about that here in a second.
Yeah, okay. And what about the volume? As you look at the volume here and see the conviction, where is it? What do we see here?
Well, yeah, if you look at the S&P 500 composite, the total volume, so if you add all of the shares that are being traded for every single component in the S&P 500, and you add those together, you're actually seeing a situation where volume is declining. It's been pretty much declining since Monday of last week. Even if you looked at Friday, an options expiration, it came in fairly light here. So today, what you would like to see, obviously a green day, but you'd like to see actually volume starting to bounce back to the upside. It's still a little bit too early to get that summer lull when it comes to volatility as well as volume. And this just, once again, maybe one of those signals that we are losing a little bit more enthusiasm to the upside here, but also kind of signifies the fact that sellers haven't really stepped in at all as well. So the lower volume and the price action kind of signifies, once again, that we are losing a little bit of momentum. But in this type of environment, prices really do hold up to these technical levels. And we've seen that over the last couple of trading sessions here. Also looking at, once again, the defensive positioning that we have seen. Usually when we have these very strong uptrends in the S&P 500, you have technology lead, you have communication services lead, and you have defensive sectors like staples actually lagging. But actually, since Wednesday of last week, staples have actually been outperforming the technology sector, even though the S&P 500 continues to move higher. That's a little bit out of the ordinary, Nicole. Usually that's a little bit of a counter trend or a sign that we might be near a near-term top, and maybe a consolidation or a pullback might be on the radar here. We don't want to really see that happen for a fifth session. And so that's what I'm going to keep my eye out on for today's session, if that trend actually does continue.
Yeah, I mean, staples, every time I look at what's winning, it's not staples. Even today, it's consumer discretionary, utilities. Today, though, all right, now, of course, right now, it's 0.01 staples, so it did go green. But it hasn't been. I check every single day. I'm always looking at these sectors. Let's talk about another group, and that's the small caps. What are your thoughts there?
Yeah, if we actually look at the Russell 2000, the 3-year weekly chart, we actually did see a really decent development that took place pretty much actually last week and kind of got confirmed a little bit yesterday here. We have a bullish cross for the MACD at the bottom. 12 EMA is above the 26 EMA. We also have that CCI thrust to the upside over that momentum line. So small caps are trying to attempt a breakout here, really decent recovery off of those lows. But the resolution of the 2115-ish area is going to be very key for the small caps. Obviously, they've been trading pretty much in lockstep with yields, and we haven't seen the full-on risk-on nature in the market, which would include small caps as of yet here. But on the weekly chart, we do have some signs that a bullish move can actually take place. And if we kind of go back and look at these MACD crosses in the past, usually 2 weeks later, Russell 2000 is actually higher. So this might not be an outperforming area of the market compared to the S&P 500 or the NASDAQ 100, but you are seeing some signs that maybe some some traders are actually nibbling here for a bit. We do have a gap there to the downside that we have to be mindful of. Gaps on weekly charts for the indexes usually don't last that long, but even a check back of that gap coming back to 2000 and trying to move higher here seems like that could actually be in the cards. But this is given a signal that maybe small caps actually maybe have a little bit of a catch-up trade over the next 2 weeks or so, barring any obviously news that kind of hampers or dampens the enthusiasm for the broader equity market.
You got to have a strong heart if you love small caps. Just over the last decade, when you're seeing things doubling and tripling and small caps are trying to give it a go, and people just tout small caps, right? It's the way to go. It's your protection. It's important in a diversified portfolio. I don't disagree or agree. It's just, they just don't get as much love sometimes.